Hello everyone and welcome to another episode of The Inflation Eating Away at Our Savings. There is a lot of talk about which investments do better or worse in times of high inflation. But what's really working and what is just personal opinion? Now I have looked at what really works. So in this video we'll hear about investments with both higher and lower risk that have worked well historically during times of high inflation. Because that's what we do on this channel, based our videos on the latest economic research. Regardless of whether inflation is high or low, we have to invest our money in some way so that the value doesn't decrease. This also happens when inflation is normal, that is when it's around 2%, which is the inflation target of most developed countries. Regardless, the value of our money is halved in just over 30 years with a 2% inflation. So after 30 years, you only have half the purchasing power left. If 30 years ago you could buy a whole chocolate bar, now you can only buy half. Figuratively speaking, of course, because the price of all goods doesn't increase and decrease exactly like the inflation. In the long term, stocks are a good hedge against inflation and have historically beaten inflation with several percentages higher returns. But in the short term, they sometimes do not keep up with inflation, as now for example. The S&P 500 is down almost 15% this year, while we have an inflation of over 8%. So we are in reality down almost 23%, unfortunately. But there are some investments that have historically performed better in regimes of high inflation. And I've found out which they are by, as usual, digging into the research literature on the subject. And there's actually one investment type specifically designed to compensate for inflation, and that is Treasury Inflation Protected Securities, or TIPS. These TIPS are fixed income funds containing loans, and these loans are almost exclusively governmental bonds, that is, loans issued by a state. These generally have higher security than, for example, corporate bonds. Of course, it depends on which state's bond you buy, but countries like the US or many European countries, for example, are considered to have very little risk of not being able to repay their loans. The special thing about TIPS compared to regular bond funds is that they are more inflation-proof, meaning that you get the return that is corrected for inflation. But before you all run out and buy TIPS, you all need to understand that these are long-term more than short-term protection for inflation and contains bonds with a medium-term or long-term maturity of approximately 5 to 30 years. And what does that mean then? Well, it means that fixed income securities, that are the loans that the fund contains, are tied to slightly longer maturities. And this is not good when interest rates go up, because then the value of these funds tends to go down. Let's say that Carl and Amy each takes out 2 different mortgages. Carl bought a home a while ago and managed to lock in a low interest rate. But since then the interest rates have started to go up. As Carl has a fixed rate mortgage, he's not affected by the higher interest rates right now. That's not good for the bank and the bond fund that the bank probably sold the mortgages to. After all, they earn less from this loan with a lower interest rate. Now, Amy, however, bought her home now and got a slightly higher interest rate. Carl's mortgage will not be as attractive than to buy when you can instead buy Amy's newer mortgage taken out with a higher interest rate. This leads to the price drop of Carl's mortgage. And this is what happens for the bond funds as well. When interest rates goes up, the value of the funds initially drops and it takes a different amount of time before they start to rise again when the interest rates goes up, depending on how long their time to maturity is. So they profit from the higher interest rates as soon as they've gotten rid of all of the old loans that was taken out at a lower interest rate. But in this situation, with such a high inflation, it is possible that TIPS still can produce positive returns, even if their prices are falling due to the interest rates increase. But of course, they perform better in a situation with falling interest rates and high inflation, which is probably not that realistic, to be honest. TIPS suits the investors who don't want to take too much risk with the money, but still don't want to lose too much to inflation. They work like kind of an insurance, and as everyone knows, an insurance is not free. So what you gain in the security, you lose in yield. But for the rest of us who wants a little bit more returns and are willing to take a little more risk, there are more opinions to choose from. Nowadays, you hear many proposals for inflation protection investments, such as real estate, commodities, collectibles, stocks in inflation-insensitive industries or value stocks, for example. But is there really any truth behind these claims that these particular investments would be better at higher inflation? Here's what the research on the subject says. So a new article has looked at how a bunch of different investments have fared on the US stock market during times of high inflation over the past nearly 100 years. And it was found that certain types of investments did better at high inflation. This table describes the returns for different stocks, bonds, and a 60-40 mixture during 8 different inflationary periods in both nominal and real terms. And here you see the total annual return during the period of high inflation, and here is the return during low inflation, as well as the total combined returns. So the stock market, that is all the stocks together, actually gave on average neither positive nor negative returns at times of high inflation, that is nominally. When you look just at the number of dollars, for example, the stock market went up or down. But if you look at the value, meaning how much you can actually buy for these dollars, it went down on average with 7%. But not all stocks do worse in high inflation, and it's been seen that energy stocks do particularly well. But there are also other types of stocks that have historically performed somewhat better during high inflation, as you can see here. I've previously also talked about different investment strategies based on factors such as size, value, and momentum. And here's how these strategies have fared during periods of high inflation. When looking at different strategies, momentum seems to be the best and actually gave better returns in times of higher inflation. Quality also produced a smaller positive return. It's probably because the prices of worse companies tends to decline more in worse economic times. Above all, I think it should be noted that all strategies had a better return than the broad stock market during periods of high inflation, which gave a 7% negative real return. But you're not limited to investing only in stocks. There are other types of assets as well, and one of these are commodities. When you look at all commodities together, historically, in the US they gave a 14% return adjusted for inflation in times of higher inflation. A pretty good return, that is. While during normal periods, they did not give a good return at all. If we look more closely at the different commodities, we can see that food commodities, those here are called agri, softs and livestock, perform the worst, but they still have a positive return of 7 to 8%. Rare metals such as gold and industrial metals performed slightly better with 11 and 19% positive return during periods of high inflation, and energy was the sector that performed the best with 41% rise. One of the reasons for this is that energy has on several occasions actually been one of the causes of the inflation, as it is right now, at least partly. What I think you should also see in these figures is that no single type of commodity gave a positive return during all inflationary periods, not even gold. If you were to protect yourself against inflation with the help of commodities, then it was a mixture of these that you should have owned in order to not go into reds at any time of higher inflation. And only livestock and industrial metals had positive returns during periods of low inflation. So it hasn't been a good strategy to own these assets all the time. You also have to understand that share prices or commodity prices are usually much more volatile than inflation, so their prices move up and down much more than inflation does, of course. And their entire price development is not solely due to the inflation either, but also other things come into play, and naturally so, one might think. So, inflation-protected assets such as tips are a better investment if you're only looking to hedge against the inflation, but this naturally comes to the price of a lower yield. Another asset class that you often hear should be safe in events of higher inflation is real estate. Historically, residential real estate often retained its value during times of high inflation. Even if the real value was somewhat negative, it was not at any great extent. To be clear, the real value is not the value in dollar, which is the nominal value, but what you can actually buy for the value. So in the US, housing prices saw a smaller decline of about 2% during periods of higher inflation, while they rose about 2% during periods of lower inflation. Similar figures were also seen in Great Britain. So even if residential real estate lost some of its value during periods of high inflation, they fared much better than, for example, stocks. Then there are other assets that you can invest in that are not bought or sold in the stock market. Here, for example, we have collectibles such as art, stamps, or wine. These all gave higher positive returns during periods of high inflation, but not as high as for commodities. Art went up 7% during periods of high inflation, while wine went up 5% and stamps 9%. Even here, however, it varies a lot during the different inflationary episodes, and none of these assets gave a positive return in all periods. Here you also have to remember that there are trends in what is popular right now. Just consider how the popularity of antiques has shifted over the years, or what art is popular now compared to in the past. And inflation is, of course, only one thing that you should consider when choosing how to invest, both for which stocks or funds to invest in and for which other asset class to own. In the end, many asset classes beat the inflation in the long term, so by just investing long term, you're well covered for inflation in the long run, even if it stings right now. So relax, and I'll see you all next time.